It's missed it, hasn't it? It has not traded inside of this box. Okay? So price could do something like this, and then the option would pay out. And the same thing applies for the miss. The price could do, something like this, and it comes down. That would be, then the option would pay out. But or also, as I illustrated before, something like this, or any combination of that. As long as it does not get inside of that box, the miss option will pay. So let's talk about how this works from a payout standpoint. First of all, let's go ahead and use the hit option. This would mean that we think that price is going to get inside of this box at some point. Go ahead and purchase price. We'll just use $200. Okay. Now, what Owanda is telling us is that if we put up $200, as long as price sometime between July 11th and July 13th gets inside of this box, they'll pay out $350.34. Now, because we spent $200 initially, that means we're making $150.34. 150.34 divided by 200. That's about a 75% return on our money if price gets inside of the box. Okay, so you can see here what the minimum payment is, what the payout is. You can see the start times and the dates. You can see the maximum and minimum level. So if I wanted to raise this up, I could raise it up, and then it'll calculate again. You can see it actually went down a little bit. Okay, and that's for the specific reason that that now, if price gets higher, I have the possibility to make money over a wider range of option prices. If I move the bottom price down, you can see down even below the current price, you can see here they're only going to pay out $197.41, which means you'll actually lose money. Okay, so that you've put up $200, they pay out $197. That's because price is below the current price. Okay, you can see here, it's already above that price. As long as it, by tomorrow, it comes inside of this box, Owanda's going to have to pay out. And since it's already above the lower boundary, that doesn't give them much of an option. So let's put it just barely above. You can see here, $61.71. So anytime between tomorrow and July 13th, if price pops up to 37.30 on the euro, let me calculate that out. We've got $61.71 divided by 200. That's a 30.8 or a 31, if I round up, 31% return on my money over just a couple of days. Remember, if sometime between July 11th and July 13th, price gets inside of this box, so it could trade down like this. As long as it pops up, you're going to get paid out. And you're going to get this payment amount. So whatever the payment is structured at the time you click on submit, that's how much money you're going to make. Okay. Now let me go ahead and talk about the mistakes that I made, just to show you what was going on. The cautionary tale here. We'll go ahead and click on show boxes. This one is actually could turn out to be a big mistake, and this was a misunderstanding in the difference between miss and hit initially in the first video. Anyway, I won't go into all the details why, but just suffice to say I read through what they were describing too quickly and then shot the video. So if you look at this box, let's go ahead and zoom out. What this box is saying, let's go ahead and view the details. This is you can see here from the details that this is an open miss. What this means is that price has got to miss this box from July 11th to July 14th, so the rest of this week. So as long as price pops up here and stays up here for the next week, this position will pay out.